After a long period of low interest rates for home buyers, mortgage rates are now climbing, as are many, I should say, are bracing for other interest rate hikes from the Federal Reserve to try and slow inflation. That could affect people buying everything from cars to dishwashers on credit. Joining us now to talk about all of this is local financial advisor Bruce Allen from Bruce G. Allen Investments. Good morning, Bruce.
Good morning, Gary.
So interest rates rising, that has been especially true since the beginning of this year. What's going on with that?
Yeah, all the news that's been moving the bond and stock markets this week is about the speed with which interest rates will be rising this year. We saw three pieces of news this week that drove the 10-year Treasury bond from a yield of 1.51% at the beginning of the year up to over 1.8% this week. Those three pieces of news are the following. One is that a major Wall Street bank predicted that the Federal Reserve would raise interest rates by 4 times as opposed to 3 times. That speed of rate it's rising surprised the markets. Number two is there's been a rumor that's been more widely circulated that the Federal Reserve will raise their first interest rate instead of by 1/4 of a percentage point. Instead, they may raise it by 1/2 of a percentage point. That's a big move, Gary, and the markets were absorbing that potential news. And lastly, the Federal Reserve minutes released this week revealed that the Federal Reserve is not only going to stop buying bonds this year, and that's been widely expected, but what was a surprise was that the Federal Reserve may actually sell long-term bonds, treasuries, and mortgages back into the marketplace out of their large inventory of bonds that they hold, and that was a negative surprise for both bonds and stocks.
That's pretty interesting. So when interest rates go up, it affects just about everything, right?
It does. In terms of, mortgages, if rates rise on mortgages, it makes it less affordable for the average American. If car loans go up, if corporate bond rates go up, any rate, this is the way that the Federal Reserve tends to tamp down an over-exuberant economy. And given that we grew over 5% last year, and we're likely to grow around 4% this year, the Federal Reserve hopes to tamp down inflation expectations and also hope that the economy can keep growing. That's the delicate balancing act that they're in, Barry.
So interest rates going up, that is causing concern for the stock investors too. What's the impact on the market been?
What we've seen is that many of the very high-flying tech stocks, some of the big, large growth stocks in the technology area, have taken the brunt of the selling this week. The S&P 500 is down a little less than 5% as of yesterday, and the NASDAQ, which has more large growth technology names, was down over 8%. So we're seeing that the large growth stocks have taken the brunt of the selling so far, at least, Gary.
Do you think that the Fed is going to raise these raise these interest rates over the year?
I do. I think it's likely that they're going to raise interest rates from 0%, where the rates are almost zero today, Gary, to by the end of this year. It looks like most economists predict that the Federal Reserve will have the short-term interest rates up as high as 1%, and that's in 2022. In 2023, they will probably rise to over 1.75, possibly even 2%. Now that's on the short end. What impacts a lot of us is what's happening on the longer-term interest rates, that 10-year Treasury bond. And where that goes, the market will determine what the yield is on that bond as we go through the course of the year. But that's likely to go higher as we see short-term rates rising. That typically means that longer-term rates go up as well.
It was fun while it lasted, I guess.
Yes, it was.
Bruce Allen, thank you very much. We'll talk to you next week.
You too, Gary.